Good evening, friends. Welcome to the latest edition of Passive Speak. Today, we will be talking about the launch of our index fund, HDFC Nifty100 Quality 30 Index Fund. As the name suggests, this fund is a smart beta product which has a factor called quality. So, what is this quality investing all about? Quality, by definition, refers to a certain level of what you call assurance on the goods and services which are offered. So imagine if you're going into a jungle safari, you would like to go with a high quality equipment, a high quality Jeep car in which you will sit, and you want it to be reliable so that you can go through the ride smoothly. So the quality assures us of this level of service or goods that we come to expect. So this quality of the product gives us a peace of mind, as one can say. So in terms of the investment world, when there are choppy times or volatile times now, like we are currently experiencing, where the market from a high of 85,000 sometime in September has come down to 75, 76,000 levels. So at such times, you would like to be with the best quality companies in your portfolio so that you can navigate yourself in the volatile times. So quality also refers to resilient businesses. They're very stable with a strong balance sheet, and they are able to navigate the stressful times because of the relative financial strength of their balance sheets, plus the resilience of their business model, which is tested through good and bad times both. So this particular strategy, quality strategy, has performed well over the long term. If you do a comparison between the Nifty 100 Quality 30 Total Return Index with the Nifty 100 Total Return Index, which is the universe, it has given a return of 13.6% versus 12.4% over the last 10 years. This data is as of 31st December 2024. Next slide. So how do we filter these quality parameters when we are selecting these stocks? There are three key parameters which are used to filter the companies from our universe, which is a Nifty 100. So these three are: one is on how one measures the efficiency of capital used, how much return you are generating on your equity in terms of profits, stability. The variance of your EPS has to be the least over the last 5 years. That means you have a consistent rate of earnings over the last 5 years. So that shows that when there are markets, there are ups and downs in the market, the relative impact on earnings is not that great. Thirdly, the financial leverage is very low. That is, the debt to equity ratio is low. Why does this help us? Low debt during times of economic downturns gives a lot of flexibility to a company to navigate the economic downturns. There are companies which are leveraged. They have a double whammy in terms of slowdown in business, but at the same time, the servicing of the interest rate continues at a higher level. When the debt equity or financial leverage is low, it definitely helps during the more tough economic environment. Okay, so let's try and understand a bit about the strategy or the factor, which quality factor, which we will be talking about, because that is the heart of this product. The underlying index or the universe of stocks is the Nifty 100 index, and stocks which have a listing history of more than a year and are in the F&O category are the eligible ones. The three metrics which are used to filter out these 30 stocks from this 100 stocks which we spoke about was the return on equity, the debt equity ratio, and the 5-year earnings per share growth variability. So there is when we are doing a stock selection of these 30 stocks from the 100 stocks that are there, we give weightage to non-financial and financial factors. And this formula briefly basically shows you that one third weightage is given to each of the three factors on the non-financial sides, at the ROE, the what you call the earning debt equity ratio, as well as earnings growth variability. And on the financial side, 50-50 weightage, 50% each is given to ROE and to earnings growth variability. So by what you call arriving at this score and multiplying by the square root of the free float market cap, we arrive at the weightage to be given to each of the 30 stocks in this particular index. So 5% is the limit of what is a maximum exposure that a stock can have in this particular index. And the portfolio review and rebalancing, weight rebalancing happens twice a year during June and December. Now, let's get to the heart of the what you call matter here, wherein how has this factor performed during market stress? So, quality as a factor stands out very sharply during during times of market downturn. So, if we look at the chart here, we have taken four such events, which during different time periods, and we have made a comparison between the Nifty Quality 30 index, which the underlying product would be replicating, that vis-a-vis the Nifty 100 and the Nifty 50. Nifty 100 because that is the universe from which these 30 stocks have been selected, and Nifty 50 because that is a benchmark index and that gives you a good reference factor while comparing the return of this particular strategy or any strategy for that matter. So during the taper tantrum, which happened during May 13 to September 13, the quality index gave a positive return of 12.3%, whereas the Nifty 100 gave a negative return of 4%, and the Nifty 50 gave a negative return of 3.5%. So clearly, quality did very well during this time. The interest rate environment was a higher interest rate environment due to certain macroeconomic stress in India during that time, and dollar had basically appreciated a lot against all the Asian currencies. Then we have the second time period, which is in June 15 till June 16, where there was a commodity bear market and there was a devaluation of the Chinese currency. So at that time, the Nifty had fallen 10% over that 1 year period. The Nifty 100 had fallen 9.5%. The quality index fell only 3.3%. The third time period we have covered is the COVID pandemic, which is pretty recent. This happened in Jan 20 to March 20 when COVID had broken out worldwide, and that had basically led to a big halt in economic activity, which resulted in a huge sell-off in most of the equity markets around the world. The Nifty had fallen in that 2 month period by 32%. And Nifty 100, Nifty 50 and Nifty 100 both had fallen by 32%. At that point of time, the quality index fell only 26.5%. Finally, there was a period in from October 21 to June 22, which was the Fed tightening and the Ukraine war situation, where the quality index has more or less fallen in line with the Nifty 100 and a little more than the Nifty 50. So what does this tell us about the quality index? What is this characteristic? Basically, in terms of economic downturn or heightened volatility in the market, the quality index generally tends to do better. And during a high interest rate environment, companies which have lower leverage, they tend to do better. People gravitate towards such companies. They buy such companies during such stressful times. And that's when this strategy starts to outperform the broader market strategies. And if there is a turn in the what you call market cycles, wherein the momentum or the value strategy which has played out very well over the last 3 years, if they start doing badly, which is currently the situation where there has been a big correction in the momentum strategies, that's when people then start exiting the low quality businesses and start gravitating towards the high quality names. Okay, next slide. So if you look at the performance of this Nifty 100 Quality 30 index vis-a-vis the Nifty 100, what you can see is that in the up years, it has matched the returns of Nifty 100 in its average performance. And when the markets have come down, Nifty 100 on average has come down 10%, then this particular index has fallen only 5.8%. So historically, their upside capture has been very good, whereas the downside has been much better as compared to the Nifty 100 on an average basis. So I think that is the USP of this product. This is why this product is come at a very right time, as you can say. Let's move to the next slide. Okay, so why invest in the quality factor now? The winners keep changing. Here we have covered, the five smart beta strategies which we have in the form of ETFs, and some we have in the form of index funds as well. So here we look at the last data for last 14 years, where we are comparing the quality index with the value index, with the growth index, with the momentum 30 index, and lastly the low volatility index. So as you can see, if you see in green, that's when the winners keep changing at different points of time, and different styles do well at different points of time. So if you look at the recent history between 2020 to 2024, the best performing in 2020, FY 2020, the best performing what you call strategy was which had fallen the least was momentum index strategy. In 2021, the best strategy was the value strategy, which had given a return of 72.8% versus 61% in the quality strategy. In 2022, the best performing strategy was the momentum strategy. In 2023, when markets had corrected, at that point of time, the best performing was the growth strategy. And FY24, where there was a big pullback again in the market, that's when momentum had outperformed. And this was closely followed by low vol and quality. In FY25, thus far, what we have seen is that the momentum strategy has corrected quite a bit. Ideally, at that point of time, the low vol strategy also should have outperformed, but it has underperformed even the momentum strategy. And the two strategies, the other three strategies have done far better, which is the growth, value, and the quality index. So, since FY20, we can see that quality strategy has broadly lagged other factors. But we are seeing green shoots in the quality performance in FY24 and FY25. We have 2 good years of returns. And typically, whenever the sector rotation happens away from momentum and value investing towards what you call the quality names, the gravitation happens towards the quality factor, and this happens when economic growth slows down. There is a bit of stress in the system. Interest rates are relatively high. They have not yet come off. So then people tend to go towards the better managed businesses. So we can see that there are evidence or signs of that all happening, and this may play out during this year and the next year, possibly, if at all this kind of sector rotation does happen. Okay, now I'll hand it over to Shikhar to take forward the presentation.
Yes, thank you, Sandeep. So I'll be covering the remaining part of the presentation till we conclude. So effectively, sort of talking you more about, the actual what the portfolio looks like and some unique features about quality as a factor. So the first unique feature about quality is that we observe, generally in the market that this factor trades at a premium to the broader market. So what that means is that the portfolio of quality companies in aggregate, their PE, so their price earnings, price book, for example, this tends to be higher than the Nifty 100 or the broad market index. You can see on the slide, we've mentioned also that currently, or as of end of December 31, 2024, the PE for the quality index was 30.33 compared to 22.3 for the Nifty 100. So, why we have created a special slide for this is that many people look at the PE and they conclude that, oh no, the quality index is too expensive, so I won't buy it because it's Nifty is much cheaper. And what we want to sort of communicate through in this slide is that there are some fundamental reasons for this happening, that there are some fundamental reasons for why quality often trades at a premium to the broader market. So if we were to take a step back, just sort of take some real world analogies, if we just look at this very simplistically, we can very intuitively understand that quality items generally, in our day to day life, whatever gives more utility than a competing product tends to command a premium. So we've given a few examples, that look at your smartphone, your iPhone has a sort of much higher price tag than, let's say, a Nokia. In terms of cars, your Ferrari will be much more expensive than a Fiat. Many, many examples in real life. Even if you go to eat, at a fancy restaurant, since the service, the ambience, the food quality you're getting is much better than you'd get, at a local vendor, the price will tend to be higher in such a restaurant, right? So in all these cases, whether it's a smartphone, car, restaurant, what these products are offering is some kind of higher utility than the competitor, right? It could be the ambience, it could be the reliability, it could just be the sort of brand value, show off value, many different things, right? But the point that all these premium products have in common is that they are offering something over and above the regular cheaper products in the market. So if we use the same analogy and look at the investing space, as Sandeep described earlier, quality companies have some traits which are very unique to them. So as we mentioned before, they are efficient because they have high return on equity. They are resilient, because they have very low debt. So whenever there is an economic crisis, they don't need to panic too much. They have more than enough cash to get through the difficult times, and they generally tend to be quite stable in terms of their growth. So they have their own ups and downs, but not as much as other cyclical businesses. So these three qualities, right? Efficiency, resilience, and stability, they are unique to quality companies. And that's why, because as we mentioned earlier, anything which is unique to a particular category will command a premium. The same thing is happening in terms of the quality universe. So if we look at some actual numbers, and we use return on equity as a proxy for efficiency, it shows up very clearly, right? The quality index has a return on equity of 26.7% as of the end of last year, and that is significantly higher than the return on equity for the Nifty 100, which is around 19.6%. So because we've used return on equity as a proxy for efficiency, it's showing again that these companies have some traits that the broader market does not have, and that is what is one of the factors leading to a higher premium for quality companies versus other companies, right? So just to dismiss the index saying that, oh no, it's 30 versus 22 for the rest of the index is not necessarily the right way to look at it. Of course, no one is saying, as an investor, you should overpay for companies, and just because a company is good quality, you should be willing to pay any PE. That is also not the case. But it is very natural in not only in Indian markets but also global markets that the PE for quality portfolio will be higher than the broad market. So this should not sort of dissuade investors. Investors need to look at it within the context that these companies are better in many ways than the broader market, and hence they are commanding the premium valuation. So with that explanation, I think now it's a good time to look at the index in a little bit more detail. So far it's been theoretical, but now you can see what kind of companies are actually in the index. What are the stats of the different indices. So if we look here on the right, all recognizable names, household names. Not a single name here that you would not have heard of or maybe used, some of their products in some way, shape, or form. Um, and I think one thing that's also worth highlighting is that this index, because the parent index is Nifty 100, the index only chooses within large caps. So that means every single stock of the 30 stocks in the quality index will be a large cap. So that's giving you an almost, a sort of um, additional layer of good quality, because to be a large cap, it's quite difficult. You obviously, competition is fierce in the market. If you have gotten to that stage, there are good chances that you have a strong balance sheet, you're very efficient, you've been able to scale, so on and so forth. So by including only large caps in this universe, it's in a way another filter to ensure that the best sort of within large caps, quality names are included in the index. Quickly, we can just go through the index stats. So, we have kind of covered this in the previous slide. PE, PB, are higher than for the quality index compared to the Nifty 100. But as you can see, the return on equity for this index is also higher than the Nifty 100. So that's one of the reasons why such a PE is kind of the norm. This is not an exception. Quality does trade at a premium very often. And before I move to the next slide, I just want to highlight another point, and that is that so far we have kept stressing that quality is trading at a premium to the broader market, right? But it's also important to see how quality has traded relative to its own history, right? And we don't have the chart right now in this slide, but from data from niftyindices.com, the valuation for the index is close to its long-term average of around 28 since 2015. So, neither while the index may look, higher than the P may be higher than the broad market because of the reasons we've described, it's important to note that relative to its own history, the valuation is quite close to the long-term average. So that can give investors some comfort that, the valuations are not very overvalued or very extended. They are actually close to their own historical average. Next slide, just again, sort of taking you through all the constituents of the index. We've seen the top 10 in the previous slide. This one has all 30. I'll just pause here for a minute. I think readers will be able to quite clearly see again, that again, just quality names, familiar names. So that's kind of the index methodology at work. So as an investor, you get a sense of what all companies you would actually be investing in when you if you put money into the scheme. Next slide is to give you an idea of the sector breakup. So how does the quality index, when you take these 30 companies, at the end of the day, how does this index look different from the Nifty 100 in terms of the sector breakup? So very clearly from this table, one can see that the quality index tends to have a higher weightage to FMCG companies, IT companies, and to some extent even auto companies compared to the Nifty 100. On the flip side, it has a low exposure to financial services and also to oil, gas, and consumable fuels. So, in effect, you can see that sector differences between this index and the Nifty 100 are quite different. They're quite stark in some cases. So, as an investor, if you're looking for some kind of differentiated exposure, exposure which is different from the Nifty 100 index in a meaningful way, this is one index which is giving it to you. And as you can intuitively understand, FMCG, IT, these are companies very sort of efficient, well managed. They're cash cows, have been in business for long time. their leverage is low. So it's really no surprise that these kind of companies are dominating the index, right? And that's exactly what the data is showing. So again, to summarize, FMCG, IT, auto overweight, and the index quality index is underweight financial services, oil and gas, and power, because these tend to be a little bit more cyclical, volatile in their earnings, so on and so forth. Next three slides, deal with the returns of the index. So we can see here that over the long run, so since inception from 2009, the quality index has outperformed the Nifty 100 and the Nifty 50. In over a shorter time frame, over the last 3 years, 5 years, again we've had the index outperform, and over the last 1 year, it has narrowly underperformed, giving a return of around 11.3% compared to 13% for the Nifty 100. So that's the kind of overall return snapshot in terms of CAGR point-to-point returns. If we look at it by FY, we can see here that the index, had a strong period from the quality index had a strong period from 2011, FY 2011 to 2016. It was, doing quite well in terms of outperforming the parent index Nifty 100. Then, maybe FY 17 to 22, it was having more of a middling performance. Of course, during COVID, it did outperform, as we have highlighted earlier. But now you can see again, from FY 23 roughly onwards, the index has started doing better than the parent Nifty 100. So as Sandeep described on the previous slide, we are seeing some degree of green shoots, in terms of the performance of this factor. And it seems to be coming back, in terms of performance relative to the subdued performance prior to FY23, for example. And if we look at the whole history, we have 15 financial years worth of data. In this, in 60% of the time, so that's 9 financial years, the quality index has done better than the Nifty 100. So that's showing you that there's some degree, a reasonable degree of consistency of outperformance as well in the quality index. Last slide, from my side is on the rolling returns. So here, as frequent listeners will be sort of familiar, we show the slide on rolling returns in many cases because it removes any sort of basically it gives you a more detailed and an idea of how consistent the performance of one index has been versus another. So you can see here, for example, if we take any 5 year period, right? If we take any 5 year period starting October 1, 2009 and ending on December 31, 2024, if we take any 5 year period and take the average return CAGR over those 5 years, we find that on average, the quality index has given you a 13.5% CAGR over this 5 year period, any 5 year period on average, compared to 13% for the Nifty 100 and 12.6% for the Nifty 50. So what this is telling you is that over many time horizons, 1, 3, 5, 10, on average, the quality index has given you a better return than the parent Nifty 100 index. So, if we just look back to what Sandeep also showed, that the upside capture is quite good. This is another way of seeing it, that when the market is doing well, by and large, the quality index is also keeping up with the broader Nifty 100, right? Second point on this slide is that these returns on average have been better and they have come with slightly lower volatility than the Nifty 100. So even though this is a relatively more concentrated portfolio because it's just 30 names versus 100 names in the Nifty 100, still, because these companies generally have favorable traits like their resilience, their efficiency, their stability, overall the portfolio has been less volatile than the Nifty 100, especially at the 1 year and 3 year horizon, right? And what is the conclusion of all this? That on a risk adjusted basis, so what we've called the return risk ratio, you can see again the quality index has done quite well compared to the Nifty 100 in a 1 year and 3 year horizon. On a 5 year horizon, it has done slightly worse, but it's still within the ballpark. And what that is telling you is that if you hold this for long enough periods, then you are getting slightly higher returns on average, slightly lower volatility, and therefore, by and large, a slightly better return risk ratio as well. So that's the sort of main conclusion from the slide, that because the names here are more focused on the strength, efficiency, resilience of the companies, this tends to be a very strong portfolio in that sense. For investors, historically, it has resulted in better returns and risk adjusted returns as well. So, with that, I'd like to conclude my section and hand it back to Sandeep to take us through the rest. Thank you.
Thanks, Shikhar. So as we can see, just to summarize the product, that is the HDFC Nifty 100 Quality 30 Index Fund. So the four key factors for this product are the long-term growth potential. Quality investing basically means you are shortlisting very high-quality businesses which have been resilient in various business cycles. They have strong balance sheets, which enable them to sustain their growth, and they compound returns over the long term. So as we saw in the previous slides, that the 10-year return, even risk-adjusted basis, is very strong for this particular index. That means companies which are well run over a long term, they tend to compound returns in terms of their price performance. Uh, these companies are sought after during times of market stress, because whenever the market has corrected, or there have been bouts of volatility which are very sharp, these companies have done far better than the average companies which are there. In bull markets, or in markets where there's a very sharp pullback, generally low quality companies tend to outperform high quality companies. But during the tough times, it's the quality companies which pull their weight, and those would be part of this particular of this portfolio of this product. Uh, Another advantage is that this is a rules based and a transparent stock selection and weightage, which is done by the index provider. There is no intervention from any fund manager. So the what you call stock selection process and the weightage which is assigned to each of these stocks is done in an objective manner as per the rules which are laid down, and this is reviewed every or twice a year, every 6 months, and the rebalancing happens. So you take away the risk of the fund manager having got their call right or wrong, as it is a passively managed product and the index is being replicated. Lastly, this is an ideal investment for investing over a long period of time. As it is an index fund, the relative cost of managing the fund is pretty low when you compare it with maybe a comparable portfolio on the active side. So the cost savings will accrue to the investor when he invests over a long period of time. So, who are the investors for whom this Nifty 100 Quality 30 Index would be an ideal product? So, customers who want to invest in equity but are very particular that the businesses where they invest are high quality businesses, well known names. They would be market leaders in their area of business. So these all would be provided through this quality portfolio, where very strong balance sheets, very resilient businesses over time with high ROEs, low debt to equity ratio, and very consistent what you call track record of delivering profits over long periods of time. These are the kind of companies which would form part of this uh, portfolio of this Nifty 100 Quality 30 Index. And of course, because it being an index fund, it would also be run at a low cost. So the customers who have a preference of having a solution at a low cost could consider this product. And the second point is that, as we have seen, is that the volatility in this portfolio is lower than the Nifty 100 and Nifty 50 over many time periods. So there would be better risk-adjusted returns which are available to the investor via this product. So these are the two key these are the what you call features for whom due to which the investors would find this suitable. We also want to briefly cover that HDFC AMC is of course a very well known equity fund house, but it where the active funds have a very long track record in the industry. We also have over 20 years of experience in managing index products. And we have a very wide range of products which we have expanded in the last 3 to 4 years. So we have 19 ETFs, we have 23 index funds, and 3 fund of funds. And this is across a wide range of strategies. So we have market cap based strategies, we have 7 ETFs and 9 index funds. We have sector based strategies, so 4 ETFs and 2 index funds. Smart beta, as this quality index is also a smart beta product, so we already have 5 ETFs and 4 index funds in the smart beta or factor based area. And then commodities, we have 2 ETFs and we have 2 feeder funds which feed into these 2 ETFs. On the fixed income side, we have 8 index funds and 1 liquid ETF. And on the international side, we have 1 fund of fund which invests in index funds slash ETFs overseas. So we are market leaders in various segments of this market cap based index funds. We have a very large, one of the largest commodity ETFs, which has over 12 years of track record. We have a small cap ETF, which has got leadership position in the industry. So all in all, we have a very, vast experience in managing multiple products in the passive space. And we offer all index solutions across various strategies. Okay, so the quality index fund, basically the investment objective is to replicate the index, which is a Nifty 100 Quality 30 index. The 2 fund managers are Nirman Morakhia and Arun Agarwal. The benchmark is the Nifty 100 Quality 30 index, total return index. There is no entry or exit load. And the minimum amount for purchase and additional purchase is ₹100 and any amount thereafter. And yeah, so since it's an equity product, its maximum allocation is to the equity side. And the riskometer shows that this is a very high risk product as it invests purely in equity. I think the rest that concludes our presentation, and we can open up for Q&A if any.
Yes, there are definitely questions. Just give me a few minutes to bring them up and ask you. One question is value, momentum, alpha. How are they different from quality? And what is beta factor investing?
So value investing basically has got different parameters than quality. Basically, the idea being that the valuation of that particular stock or that particular stocks which are filtered are cheaper than the rest of the market. Hence, you have a value which you are investing in, which is of a lower valuation. Momentum and alpha. Momentum, of course, is looking at the absolute positive price momentum, the recent momentum in the price of those particular stocks which are shortlisted, whichever exhibit the highest positive price momentum are shortlisted for the purpose of investing, and they tend to look at which were the most recent stocks which have done well and which will continue to have that what you call resilience to continue doing well, and that's how the stocks are shortlisted. Alpha, those stocks which generate, I guess, a higher return than the other what you call the broader market. So they are generating an alpha over the benchmark indices, and there also we are looking at the highest positive price which the stocks would exhibit than the rest of the market. So they are very different in their objective from what you call the quality strategy, so to speak. Quality are looking at parameters like return on equity, the debt to equity leverage which is there, and the last 5 years earnings EPS growth, where the lower amount of variability enables those companies to be shortlisted. So they have very different objectives. Different kind of stocks are selected, and various strategies do well what you call at different points of time. So the alpha momentum value strategies do well in bull markets, when stocks are doing very well and people are willing to go down the curve of lower quality stocks because they feel that the growth potential there is higher and people are willing to take that risk. Quality, in contrast, people tend to gravitate towards times of market stress, and when markets have what you call they're not doing that well, maybe the economic cycle which was there of expansion has started contracting or slowing down. That's when the quality strategy starts coming into favor. When interest rates are not cut, they remain high. The companies which have lower leverage, they tend to do better. That's when the quality companies do better. So the investment style or is very different for these strategies.
Sandeep, sorry to disturb you, but the screen is not visible.
Screen is not visible.
Is it visible now?
No.
I think it's buffering, Shikhar. Check your connectivity. Okay.
Okay, we can just go to the next question till then. How is this different from Nifty 200 Quality 30 Index, which is better from stability point of view?
Nifty 200 Quality 30 is a wider universe where 100 large caps and 100 mid caps are the universe, and from there you are picking up these 30 stocks. Whereas the Nifty 100 Quality 30 Index is purely a large cap focused product, where from the top 100 large cap names, 30 names are selected. So, in terms of stability, I'm not sure whether there would be much of a difference, but yes, because this is restricted to the large cap universe, the relative volatility would be lower for this product. And I guess in terms of what will be the performance in the future, that would be difficult to predict, but this kind of a product would be more true to label in terms of looking at well-run large businesses which have been there for a long time. When you go down the market cap curve, some of the quality parameters would start getting a bit diluted. So from that perspective, I think this product would be more true to label and would deliver better on the objectives if one is looking at, lesser amount of volatility in the portfolio.
Okay. In most of the financial years, the said strategy has underperformed other strategies. So how does this make sense for retail investors who are likely to hold the same for the long term? So I'll just hope the screen is visible. But Sandeep, as you know, we have that slide where we've seen that over the last 15 financial years, 9 times the index has actually outperformed. So I'm showing that slide. I don't know if the screen is visible, but
No, it's still buffering.
Okay. I'm just trying to adjust the connectivity also.
Yeah, so we had shown the data for the last 15 years, as Shikhar had pointed out, where we had compared the quality versus the quality strategy versus the Nifty 100 and the Nifty 50. And what we had seen in that is that out of the 15 years, 9 years, this quality strategy had outperformed the Nifty 100 and the Nifty 50. If you look at the specific time period, uh, between FY11 and FY16, this strategy has had for each of the financial years then outperformed both the Nifty 100 and the Nifty 50. And only when market conditions started changing later, that's when the Nifty 100 and the what do you call Nifty 50 started doing better. So, these are what you call very tactical calls which one takes. And if you see that full circle seems to have come because again in the last two financial years, that is last year FY24 and FY25 year till date, the quality index has again started outperforming, even if for that matter FY23 it had outperformed the Nifty 100 and the Nifty 50. So it seems as the that the sector, the style rotation is again going in favor of quality away from Nifty 50 and Nifty 100. So that answers your point as far as the FYTD returns are there. And the other point is that if you look at even the CAGR returns which are there in this product, over 3 and 5 years, it has done better than Nifty 100 and Nifty 50. And I think that is a fairly long enough time period for someone to have, put money in this strategy to kind of judge how it would do. And I think this strategy is something, as we had also said, if you look at the rolling returns, then it has done much better in 1, 3, 5, and 10 years on an average rolling return basis, if one were to take away the bias of looking at the returns at a particular point of time. So I think this strategy has done pretty well versus the Nifty 100 and the Nifty 50, and definitely can be considered for long-term investing as well as investing from a medium-term perspective.
Okay. What is the TER of this fund?
I think we have mentioned this in it's 40 basis, right?
Yeah, we've not put it in the presentation.
For the
It's
direct,
expected to be around 40 bips for the
for the
direct.
direct plan.
Yeah,
Yes.
and around 90 bips for the regular commercial GST. Okay, then next question. In how many days is the NFO collection deployed?
So I think it has to be deployed within 5 working days from the date of the close of the NFO. That's the
Correct.
SEBI
And
regulation.
also just worth noting that because this is a passive fund, obviously, the fund manager does not want to take any cash calls. Otherwise, the tracking error of the scheme would increase. So when he is sort of deploying the money, he does it as quickly as possible to ensure that he is tracking the index extremely closely. And that will be done within 5 days after the NFO closes. Just FYI, the NFO closes on Feb 14th. So within 5 working days of that, the money will be deployed in quickly. Okay. What is the difference between this one and low volatility?
Low volatility, the parameter standard deviation. The universe is the same, Nifty 100. The stocks which exhibit the lowest standard deviation are shortlisted. And here the parameters, as we spoke about, were on the balance sheet parameters and the profit variability parameter which is there. So from the construct of the index point of view, they are very different. But the another hallmark of quality portfolio is that the individual constituents exhibit lower volatility as compared with the broader markets. So there can be a case where there will be some overlap in the shares which are shortlisted for both the factors, that is low vol and quality.
Okay. Okay, then will an ETF also be available?
Yes, so we have an ETF which has been in place for more than 2 years now, which is what you call HDFC Nifty100 Quality 30 exchange traded fund. This is available on both NSE and BSE for purchase and redemption.
So just for simplicity, the symbol is HDFC QUAL. That's the symbol. If you search for that in your on the your brokerage terminal, then you should get the ETF. What is the difference between Sensex and this index?
Sensex is a blue chip large cap index which is constructed by BSE, and they represent the 30 largest companies by free float market cap in what do you call Bombay Stock Exchange. This product is provided by NSE, and this has a universe of 100 stocks, of which 30 are shortlisted based on the parameters that we have discussed during this presentation. So both are very different in terms of how they are constructed.
Okay, then some questions around SIP, that when will SIP be available in this scheme? And also, should one invest through SIP or lump sum?
I think we are offering SIP in the NFO as well in this.
Correct. Correct.
Yeah, so you can do both lump sum and SIP in this product during NFO and even on an ongoing basis. And this product, because it's an equity product, is suitable both for lump sum investing as well as for SIP investing. So in case the investor feels that he would be better served in investing in an SIP, and he can do that for the long term, he would find it much easier to operate. Then one can also opt for an SIP in this product. So it basically is the investor's convenience, how he wants to approach this to invest. So I think both forms of investment in this product would be ideal.
Okay, then we have one question that, given the tax payouts, switching between different types of factor funds would be quite difficult and expensive for individual investors. So, can we get a fund of fund scheme at some point?
So currently, what you call in the current situation, it's not very easy to get regulatory approval for having a fund of fund which invests across passive schemes, but that is definitely something which we would also like to explore and launch if at all the what you call regulatory and market environment is suitable for the same.
Correct. And generally, as Sandeep said, this is a little bit of an industry-wide phenomenon at this point, that new fund of fund launches are a little bit facing challenges across the industry at this point. Okay, then another question was, how has the fund performed when the market has fallen 15%? So during the current period, so far, the if we look at, let's say, from the current drawdown from September onwards till now, the Nifty 100 is down around 14%, and the quality fund has fallen. The quality index has fallen around 14.8. So it's just about in line with the Nifty 100 index. But I would want to mention one other point which was not in the presentation, and we had done some additional analysis on this, is that at least historically, when market stress got very significant, and you had Nifty 100, for example, selling off more than 20%, in those kind of scenarios, then the quality index almost always, in fact, at least in the data we have from 2009 to now, there are around maybe 120 instances in terms of periods where the Nifty 100 index was down more than 20% in a given month, but the quality index was had fallen much less. So as Sandeep had shown in the previous slides, and I have also shown that then when the market stress is significant, when there are deep sell-offs in the Nifty 100 index, that's when the quality index tends to do better. When the sell-offs are smaller and shallower, then sometimes the quality index falls around as much as the Nifty 100. That's what we're seeing right now. But historically, if there's been a major sell-off, more than 20%, we've seen that then the quality index has done better than the Nifty 100, and it offers some relative degree of protection in those kind of scenarios. Again, it's all relative. The quality index will also go down if the market goes down, but there could be, as we've seen historically, somewhere we saw about 5 to 10 percentage points worth of outperformance in those seriously stressed market scenarios. So that's worth keeping in mind. Sandeep, I think we're close to running out of time. So if you'd like to just summarize, and
Yeah,
then
so
yeah.
okay, so the name of the product is HDFC Nifty 100 Quality 30 Index Fund. The NFO opens on 31st Jan, that is this Friday, and it will close on 14th Feb. This is a what do you call product, which is a smart beta product or a factor-based product, which the emphasis is on quality, which we have covered during the length of this presentation, where we look at three factors, which is the ROE, the debt to equity ratio, and the 5-year EPS earnings variability. These are the three parameters which are used to select 30 stocks from Nifty 100 universe. And this is rebalanced twice a year. There is no entry or exit load in this product. And this is an index fund or a passive product, as the name suggests. So I hope you all found this presentation informative and enlightening as far as this product was concerned. And thank you very much for your participation.
Thank you all. We will conclude the call now.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.